Hi friends, welcome back to EduTap. So today we are going to talk about a very interesting topic. This topic is of ratio analysis, a very important topic from examination perspective. We are going to discuss some of the important MCQs, and with these MCQs we are going to try to cover this entire topic of ratio analysis. So let's start our discussion. So let's start the discussion with the first question. Which of the following is a liquidity ratio? Debtor turnover ratio, current ratio, operating ratio, gross profit ratio, or none of the above. Now let's understand the concept of ratios. Now what is a ratio? Ratio is something like 1:2, 1/4. So they all are type of ratios. In accounting also we are using different sorts of ratios to depict different things. Okay. In accounting we have a balance sheet which is prepared. This balance sheet, it shows the assets and liabilities of a company. There is a statement of profit and loss which is prepared. The statement of profit and loss, it shows the revenue, it shows the operating expenses, it shows the other expenses, and it gives us a picture of the net profit that the company has made. So now sometimes we find out different ratios to better understand our financial statements. For example, if we have to compare the net profits of the 2 years, it's better to find the net profit ratio. That is net profit divided by revenue, net profit divided by total sales. So we can compute this ratio for 2 different years and we can compare them whether the ratio has improved, whether the ratio has declined. Similarly, what we can do? We can have a ratio in which we compare our debt with equity. The company has taken some loans and the company also has some money which has been obtained from shareholders. So if you have to check how much the company is risky, you can compute this ratio of debt equity ratio. Okay. So if the debt in the company is very high, it means the company has lots and lots of amount of borrowings. So now if the borrowings amount is very high as compared to the shareholders own money that has been put in the company, then this company is going to be very risky. For example, for one company, this ratio is 1:1. This means that loans and shareholders money, they are both equal. For the other company, this ratio is 4:1. It means that for every 1 rupee the shareholders have put in, loans of rupee 4 have been taken by the company. So it means this company is going to be very risky. So to make out various decisions, we need to calculate certain ratios. And that's why accounting ratios, they are a very important tool of the financial statement analysis. Now from accounting perspective, we have different kinds of ratios. We have liquidity ratio, solvency ratio, activity ratio, and profitability ratios. You may also find another category of ratios or some other classification in different textbooks, but this is the broad classification which is always adopted by everyone. Now by liquidity ratios we mean we try to find out the liquidity related indicators of the company. For example, we want to know whether the company has enough liquid funds, enough funds available which can be easily utilized to meet any emergency requirement. So the company must have enough current assets to meet its current liabilities or any other emergency situation. Then is the solvency ratio. Now the solvency ratio is about the proportion of debt and equity in the company, the proportion of borrowings and the proportion of the owned funds in the company, like the debt equity ratio we just talked about. There are activity ratios. They tell us about how the activity in the company is going on, whether the company is effectively utilizing its assets or not. Now this ratio, it becomes very essential. Okay. For example, let's suppose there are two companies, company A and company B, and we have two figures which are given here. Okay. One is turnover. Suppose the turnover of both the companies is say 10 crore. Now suppose if I ask you which company seems better to you, you may say, okay, both the companies, they are perfectly fine. But I would say I need some other indicators as well. I need some other financials as well. For example, I say the company A, it has invested 100 crore in fixed assets, and the company B, it has invested 200 crore in the fixed assets. Now the company A, it would seem better because it has invested less in fixed asset and it is generating the same turnover as the company B is generating. So the company number A is better in effectively utilizing its fixed assets. This can also be the case with the current assets, working capital, or any other sort of thing. Then are profitability ratios. profitability ratio, like we talked about, net profit ratio. We compare the net profit and the sales. So they are simply going to relate to the overall profitability, overall performance of the company. We are going to study all these classifications, all these ratios in more detail in the form of the MCQs. So the question which we have now is with regard to the liquidity ratio. Now this liquidity ratio, it talks about enough liquid funds with the company. Now what do we mean by liquidity? By liquidity, we mean that we should have cash, or we should have those sorts of investments which can be easily converted into cash. So from the firm's perspective, I am broadly talking about current assets. So the firm must have the current assets to meet the current obligations which may arise in the near or short term future. Now there are two liquidity ratios which are very important. One is current ratio. Now this current ratio, the name suggests it is going to be about the current assets and current liabilities. And this is exactly what this is about. Current ratio, it is the proportion of current assets to the current liabilities. Now suppose there is a company whose current assets, they are 20 lakhs and the current liabilities, they are 5 lakhs. So I would say the current ratio is going to be 20 by 5 or 4:1. Now if the situation was opposite, the ratio would be 1:4. That would be a very risky ratio because you have current assets of only 5 lakh. But if you have the current liability of current asset, suppose 5 lakh, current liability suppose 20 lakh, this would be a very risky proposition because the current liabilities, the people are going to come in and ask for the money, but you are only having the liquid funds of rupees 5 lakh only. So higher the current ratio, the better it is going to be. The more the current assets in comparison to current liabilities, the better situation you are going to be in. Now a problem arose here that the current assets, they are not always very liquid. The current assets, it comprises of some things which are not readily realizable in cash. Also, there may be some things which have already been incurred, but they are just being reflected as current assets from accounting perspective. Okay, for example, there may be certain prepaid expenses. Okay, you have already paid for the insurance of the business in advance. You have already paid the salaries of the employees. You have already paid your taxes in advance. There can be advance tax as well. So now these things, they are also included in the current asset in the balance sheet of the company. Now they have already been paid. You are not going to realize them again. So if we have to calculate the liquidity position of the company, it is slightly wrong to consider these as current assets for the purpose of computing the liquidity ratios. So now we compute a better measure of the liquidity, which is liquidity ratio. Okay, this liquidity ratio, we are going to change the numerator from current assets to quick assets or liquid assets. Okay, in the current ratio, current assets divided by current liabilities, the numerator was current assets. But when we are talking about quick ratio, this is going to be about the quick assets or liquid assets divided by current liabilities. So this numerator is something which is going to change here. Now the quick assets, they are current assets minus inventory. Okay, the stock we are going to exclude because stock may not be something which you can easily sell and get all the money. And also we are going to exclude the prepaid expenses, advance tax, etc. So then we get quick assets and then we compute this particular ratio. This is also referred to as the AC detached ratio. So this is broadly about the liquidity ratios that we are having. So liquidity ratio is a more better measure as compared to current ratio of the liquidity position of the company. So now we can easily answer that out of the following, only current ratio is the liquidity ratio. So answer is going to be option number B. Moving on to next question. Which of the following is not a solvency ratio? Okay, we have learned what are solvency ratios. We have broadly understood about them. So let's try to answer it. Debt equity ratio, proprietary ratio, working capital turnover ratio, interest coverage ratio, or none of the above. So broadly as of now, you know that solvency ratio, they relate to the debt equity position in the company. So just think about it. Okay, just read all the options and think about it and just make a guess as of now. Okay, your guess may be correct if you have understood what are solvency ratio. If you have understood the core concept behind it, you would easily get the right answer here. So solvency ratios, they are calculated to determine the ability of a business to service its debt in the long run. So they are about the solvency position of the company. So even if from a simple layman perspective, we know when we say someone has gone insolvent, okay, When do we say someone has gone insolvent? When the debt of the person is higher and the person is having less money in his pocket. So same is the case for the companies and for any business. Okay. So for the business as well, we are going to compare its borrowings. We are going to compare its debt with the owned funds. In the case of company, this is going to be the shareholder funds. So we are broadly going to compare debt equity in the solvency ratios. So first ratio is itself the debt equity ratio, a very important ratio. It is about the proportion of long-term debt and equity. Now just remember this thing, that here we are only considering the long-term debt. Okay, we are not considering the short-term debt. If we have purchased any goods on credit, that is going to be a short-term scenario, and that is going to be a current liability, not going to be included here. And here we are specifying equity. Now this equity, it refers to shareholder funds. Now these shareholder funds, they comprise both equity as well as preference. They also comprise of the reserves and surplus which are sitting in the balance sheet, because we already know that these reserves and surplus eventually belong to the equity holders only. It is considered safe if the ratio is 2:1. So for every 1 rupee of your own, if you are taking up to 2 rupees of debt, this is considered safe. If the ratio is more than it, then it is going to be very dangerous situation. So debt equity ratio, name itself makes it clear that the ratio of debt to ratio of equity. Okay, so this is the most popular formula which is being followed. You may also find some other variants of this formula, but this is the most popular version which is being used everywhere. Then is the proprietary ratio. Okay, who is a proprietor? Proprietor is the owner of the company. Proprietor, it refers to the owner. Now proprietary ratio, this is going to be about the ownership or the shareholders. So it takes into account how much of the total capital employed in the company comprises of the shareholder funds. Okay, now this capital employed, it refers to long-term debt plus shareholder fund. In the balance sheet of the company, on the liability side, we have share capital, we have reserves and surplus, we have long-term borrowings that we have made, and then we have current liabilities. In the capital employed, we are considering share capital, reserve surplus, and all the long-term borrowings. So this is one approach to calculate the capital employed. It can also be calculated by a different approach in which we use fixed assets plus current assets minus current liabilities. So this can be another approach which can be used to compute capital employed. So broadly, you have to remember the total long-term funds employed in the company. It is going to be capital employed, and this is going to comprise of both shareholder fund as well as the long-term borrowings of the company. So now this ratio is shareholder fund divided by capital employed. How much of the total capital is composed of the shareholder funds? Then is total asset to debt ratio. Now the name itself makes it clear. We are going to have in the numerator total assets, and in the denominator we are going to have long-term debts. So this would let us know how much of the total assets they have been financed by debts. Then is interest coverage ratio. Now this interest coverage ratio, very interesting ratio. This is mainly relevant for the people who have given loans to the company and they need interest from the company. So this ratio is going to consider in the numerator the profit before interest and tax. Okay, the profit that the company generates before making any interest payment. And this is going to be divided by the interest payment that the company has to make. Now suppose if the profit before interest of the company is 10 lakh and the company has to make an interest payment of 2 lakh. So this is going to be 5 times. So it is a very good situation, because to cover its interest obligations, the company is having profits of more than 5 times. Okay, the company is having profit of rupees 10 lakh. So now this seems very safe for any person who has given funds to the company on interest. So this is going to be this interest coverage ratio. How much interest is being covered by the operating profits of the company? So now we can easily answer this question. We know that there are 4 popular solvency ratios. Debt equity ratio is one of them, proprietary is one of them, interest coverage ratio is one of them. Working capital turnover ratio, this simply suggests it is a turnover or activity ratio. So this is not going to be included here, and answer is going to be option number C. Now let's move to the next question. This question is, dash ratios express the number of times the asset employed, or for that matter any constituent of assets, is turned into sales during an accounting period. Solvency, liquidity, profitability, or activity, or none of the above. Now I believe you guys can easily answer this question as of now. We have already talked about the basics of all the 4 classifications of ratios. We have talked about in detail about the liquidity and solvency ratios. And now you can easily answer what ratio is being asked in this particular question. So yes, guys, you guessed it right. The turnover ratio or the activity ratio is something which is being asked in this particular question. Now these ratios, they indicate the speed at which the activities in the company they are being performed, how effectively the company is utilizing its assets, and this signifies efficiency and profitability of the company. We have different turnover ratios. For example, we have inventory turnover ratio, which tells us how fast we are converting our inventory, our stock into revenue, into sales. How fast are we in converting the stock that we are having into the sales. Now this ratio is calculated as cost of revenue from operations. Okay, this is nothing but the cost of the goods sold divided by the stock that you are having. Average inventory is considered here. So in the numerator, we take the cost of the goods that we have sold. This can also be taken as the net sales. Sometimes some books it takes it as net sales, okay, instead of cost of goods sold. Some books they take it as net sales divided by the stock. So both are equally valid, both are equally taken in the different textbook, but more preference is to be given to the cost of goods sold. So cost of goods sold divided by stock, this is the formula. How fast are we converting this stock into sales? Then is trade receivable turnover ratio. This is also referred to as the debtor turnover ratio. So this is about how fast we are converting our receivables into cash. So if our receivables are less as compared to the credit sales that we have made, so it signifies that we have converted our receivables into cash in a very short amount of time. If the receivables are very high in comparison to the credit sales that we made, so this signifies we are very slow in collecting money from the receivables, from the debtors. So on the numerator, read it very carefully. We are having net credit revenue from operations. We have net credit sales. So if we are talking about debtor turnover ratio, the debtors they are only going to arise if we are going to sell goods on credit. If we are going to sell goods on cash, there is no question of debtors. So that's why in the numerator we have net credit sales and we are dividing it by average trade receivables, okay, by the average debtors or the average amount of money that you have to receive for the goods that you have sold. So this ratio is going to indicate how receivables are turned over and converted into cash in the accounting period. Similarly, there is a trade payable turnover. So this is very much similar to the previous ratio. So in the numerator, we are having net credit purchases. Okay, instead of net credit sales, we have net credit purchases. And in the denominator, we have the average trade payables that we are having. So now this ratio would signify how fast are we paying money to our creditors. So there are some other sorts of turnover ratios which are also there. There is an investment or the net asset turnover ratio. So now this ratio it consider in the turnover ratio, you have to remember this thing. Okay, always remember this thing that in the numerator, we are always taking sales or cost of goods sold or purchases in case of turnover. Okay, so in the numerator, we are always going to have some revenue figure. Okay, revenue figure is going to be there, and in the denominator, we are going to have that figure for which we are computing the turnover ratio. For example, if we are computing the net asset turnover ratio, then we are going to have net assets in the denominator. Now these net assets, they are nothing but the capital employed. I have already explained to you that you can compute capital employed from two perspectives. One is this perspective in which you consider the share capital, you consider the reserves and surplus, you consider the long-term borrowings, and the second perspective in which you consider the fixed assets, current assets, and you deduct the current liability. So both are equally good. Okay, so this ratio is net asset turnover ratio, or it can be capital employed turnover ratio as well. So capital employed or net assets, they are same thing. So that's why this is being used in the denominator here. Now, to better understand this particular ratio, net asset ratio, we are also computing the fixed asset turnover ratio and working capital turnover ratio. So this capital employed, it comprises of number one, fixed assets. Okay, from the second approach that we could use, this comprises of the fixed asset and the working capital, that is current asset minus current liability. So we compute separate turnover ratios for them. Fixed asset turnover ratio, in the numerator we are going to have sales and in the denominator we are going to have fixed assets. And working capital turnover ratio, in the numerator we are going to have again sales and in the denominator we are going to have working capital. So this is how you should remember these ratios. Okay, if the ratio is higher, then it signifies that it is a very good sign and it implies efficient utilization of the resources of the company. So now we can easily answer this question that activity or turnover ratios, they are the ones which tell you how effectively you are utilizing the assets. So that's why the answer is going to be option number D. So now the next question is, which of the following is not a profitability ratio? Operating ratio, earning per share, return on investment, proprietary ratio, or none of the above. So friends, we have already discussed the other three classifications of ratios. So only one left is profitability ratio. So now you can easily mark out the right answer by just following the elimination method. So now let's try to understand about the profitability ratios. Now the name itself makes it clear that we are going to have a look at the indicators of profitability of the company. The most popular indicator is net profit. Okay. Other indicators, they include operating profit and gross profit. So what are these indicators? Let's try to understand. Now, for any company, when we are preparing the statement of profit and loss, what figures are we going to have? We are going to have the net revenue from operations that have been generated. Okay. The revenue, the sales that have been made by the company. And from the sales, we are going to subtract the cost of these sales. We are going to subtract the cost of the goods that we sold. Now, subtracting this particular figure, it is going to give us gross profit. Okay. And if we further subtract operating expenses from this particular figure, okay, the expenses which are related to the normal operations of the company, then we are going to get operating profit. And from this figure of the operating profit, when we subtract all other expenses, okay, all the expenses which are remaining, all other expenses, we are going to arrive at the figure of the net profit. All the non-operating expenses are deducted and we arrive at the figure of the net profit. So now what we are doing in these profitability ratios, we are simply comparing the different profits that we have made with the sales figure. So if we have to compute the gross profit ratio, we are going to do gross profit divided by sales. If in percentage terms, this can be multiplied in 100. If we have to find the operating ratio, we are going to have operating profit divided by sales in 200 for percentage. Net profit ratio, net profit divided by sales in 200. This is what we are going to do. Now there is another ratio which is operating ratio. Okay. Just do not confuse it with operating profit ratio. Operating ratio and operating profit ratio, they are separate. They are totally opposite in fact. Now this operating ratio, it talks about the operating expenses and the cost of goods sold of the company. So if we total these two figures, okay, cost of goods sold and the operating expenses, and we divide it again by net sales, then this is going to be your operating ratio. So this is totally opposite. This is totally opposite. What? This is totally opposite of the operating profit ratio. So here we have different profitability ratios, and now I believe you already know much about them. Gross profit ratio we already know. Operating ratio we know. Operating profit ratio we know. Net profit ratio again we know. There is return on investment or return on capital employed. Now this is about the profit before interest and tax. Okay, EBIT. PBIT, EBIT, earning before interest and tax divided by the capital employed into 100. So how much operating profits you are generating from the total capital employed in the company. So this is your return on the investment. This capital employed is simply the amount of money that has been invested in the company. This may be the shareholders' money, or this may be obtained by borrowing. This may be obtained by debenture holders. This may be obtained by debt. So total money that we have invested in the company is considered. And here also the total operating profits of the company, they are considered. It is EBIT is considered before deducting any interest or tax. So now there are some other sets of ratios which are there. So one, there is return on net worth. Okay, now this return on net worth means how much return you are generating for the shareholders of the company on their funds invested. So now the profit after tax, okay, the profits which remain after tax, they eventually belong to the shareholders. So we are comparing this profit with the funds which are given by shareholder. Profit after tax divided by shareholder fund into 100 for percentage. Then is earning per share. This simply means how much earnings we have generated per share for the equity holders. If the company has suppose generated 10 lakh earnings which are available for the equity shareholders after repaying each and everything, interest, taxes, preference, dividend, everything, and this earning remains for equity holders and there are 1 lakh shares in the company, this is going to be 10 per share. Dividend payout ratio. Now we are making an earning of 10 per share. We may not give this entire earning of 10 per share to the shareholders. Okay, we are going to keep some earnings with the company itself for making further investments, okay, in different alternative projects. Suppose we are only giving 5 per share as dividend. So 5 by 10, this is going to be dividend payout ratio. 50% or 1 by 2, this is going to be the dividend payout ratio. It means that only 50% of the earnings per share are being distributed as dividend. Then there is price earning ratio. Now the price earning ratio, the name itself says we are comparing the price and the earning. We are comparing the market price of the share with the earning per share of the company. So this would signify that how much the market price of the company is in comparison to with the earnings which the company is making. Suppose the earnings of the company are rupees 10 per share and its market price it is suppose 100. So this would mean that this ratio would come out to 10. This means that for 10 rupee earning, we are having 100 rupees as the market price. So market price divided by earning per share. This would reflect the investor expectation about the growth in the firm's earning and the reasonableness of the market price of the shares. So the market price should be reasonable as compared to the earnings of the company. So if there is a company, okay, there is a company 1, there is a company 2. Let me ask you this question just popped up in my mind. Okay, now there is one company whose PE ratio, okay, PE ratio, price earning ratio is 20, and there is another whose PE ratio is just 2. Now, in which company would you like to invest money? There may be different reasons. Okay, let's just ignore all the other reasons and just concentrate on this PE ratio. For the company 2, for the profits that it is making, for the earnings that it is generating per share, the market price is just twice. And for the company 1, for the earning that it is generating for 1 share, the price is 20 times. Okay, this company is very much overvalued. The price is 20 times with regard to the earnings that are being made. And for the second company, this company is undervalued. Okay, the price is just twice of the earnings that the company has made. So you would rather prefer to invest in the company number 2. So this is how the investors analyze the ratios and they make different investment decisions. So now we can easily answer this question that out of the following, proprietary ratio is not a profitability ratio because it is a solvency ratio, as we have already learned previously. So I believe after discussing the first 2 questions, you would have easily marked out all the other questions. Okay. Now this question is specifically for you guys. Okay, everyone should answer it correctly. I've discussed it many times in this lecture as well. Capital employed is equal to, this capital employed is a very important figure when we have to compute different ratios of a company. Now this capital employed is equal to what? This is being asked here. Now we have already discussed that this capital employed can be computed by 2 approaches. Let's see if you can get them right. Long-term debt plus shareholder fund, total assets minus current liabilities, shareholder funds, both A and B, or none of the above. Now there are 2 approaches to calculate the capital employed. Okay, let's understand them. So let me prepare a balance sheet. Okay, let's try to understand it. In the balance sheet of the company, I'm preparing it this in T format. Okay, the old T horizontal format. We have fixed assets. Suppose the fixed assets are 10 lakh. We have current assets. Suppose the current assets are again 10 lakh. We have share capital. Suppose the share capital is say 5 lakh. We have reserves and surplus. Suppose the reserves and surplus they are let's assume they are 3 lakh. We have long-term borrowings in the company, and let's assume that these long-term borrowings are say 7 lakh. Okay, we also have current liabilities. Let's assume they are 5 lakh. So total of the balance sheet, it is always equal on the both the sides, asset side and the equity and liability side. The total is always equal. So this is going to be 20 and this is going to be again 20. So now to compute the capital employed, we have 2 approaches. One approach is long-term debt plus shareholder fund. So if we use this particular approach, how much is going to be the capital employed? Okay, long-term debt, it is how much? By approach 1, long-term debt, long-term borrowing is 7 plus the shareholder fund. This comprises of the share capital plus the reserves and surplus. So this would turn out to 15. And if we follow the approach number 2, okay, approach number 2, it says total assets minus current liabilities or fixed assets plus current assets minus current liabilities. So fixed assets plus current assets minus current liabilities. So this again turns out to 15. So the figure is same in both the cases. So you have two different ways you can compute capital employed. How would you actually do it would depend on the information which is given in the question. So now we can easily answer this question that capital employed, this is equal to both A and B. So answer is going to be option number D. So thank you guys. This was our discussion on the very important topic of the ratio analysis. Now in this particular video, we mainly focused on the concepts and the practical discussion. It was very less. Now we are again going to have another discussion on ratio analysis, and in the next part of this video we are going to talk about some practical problems based on ratio analysis, which are again very important from examination perspectives. So do watch the next video as well. So this is it for now. Bye bye, take care, all the best.